We have to discuss Meta, Amazon, and Apple's earnings reports right now because this is absolutely crazy. Meta blew it out of the freaking water and is up 14.5% now in after hours trading. Amazon is also up roughly 7% in after hours trading, and Apple is down 2% at the last time that I looked at it. I am making this video about half an hour after these companies reported their earnings, and I just want to give you guys my raw, honest thoughts on these reports because they are quite crazy. Also, Meta is apparently a dividend paying stock now. So that's a thing that's happening now in the markets. So investors can be expecting to get dividends from Meta now. So as I'm sure you can probably tell, there is a lot that we got to cover in this video. But very quickly, because I have received a lot of questions, my book, The Fundamentals of Investing, will be released on Amazon on Monday. So if you have been waiting for the release of my new book, then again on Monday, you will be able to purchase it from Amazon. And there will be an ebook version and then an actual print version. You can actually see the print version on my shelf right there. So you'll have the option of which one you want. But with that being said, let's dive into this earnings madness. And let's start off with Meta because this is going to be the hot topic of what everyone's going to be talking about. So right here we can see that Meta did $40.1 billion in revenue for the fourth quarter of 2023, which is a growth of 25% year over year. That is absolutely mind-blowing. They grew their revenue 25% year over year. This is far beyond my own expectations for Meta. Like when I was a shareholder of Meta, looking back, that was obviously a mistake to sell in the $250 range. But looking back, I did not think that Meta was going to be growing its revenues at 25% annually. I was expecting anywhere between 3 and 8% revenue growth. So Meta is blowing it out of the water. Congratulations to everyone who is still holding. This is a great report. They absolutely killed this one and knocked it out of the park. Diluted earnings per share is also $5.33 for the fourth quarter, which is up 200% year over year. So Meta is getting its profitability back up in a major way as well. Family daily active people did grow by 8% year over year. So within Meta's family of apps, they are continuing to gain more users, and their daily active users did grow by 8% year over year. They also have over 3 billion people that are daily active within their family of apps now, and 3 billion people growing at 8% per year. That is still a great growth rate at that massive scale. Now, getting into Meta's dividend, they did declare a dividend of 50 cents per share per quarter, which is $2 per share on an annual basis. So investors in Meta can now expect a $2 per share annual dividend payment, which is a small dividend, but it is still a dividend payment. They are returning some of that cash to shareholders through a dividend. Meta is also expecting about $35 to $36 billion in revenue for the first quarter of 2024, which is pretty solid growth year over year. So the company is continuing to grow. Now, if we move on to Meta's cash flow statement right here, we can see that they produced $19.4 billion in operating cash flow, which is up from $14.5 billion last year. In the trailing 12 months, they've also produced $71.1 billion in operating cash flow now, which is an increase of roughly 40% year over year from the $50 billion that they did in 2022. So their profitability is going up massively. Now, if we take a look at their capital expenditures, their CapEx is also declining. So Meta is seeing its operating cash flows increase and its capital expenditures decline, which means that its free cash flow is growing significantly. In fact, the company did about $46 billion in free cash flow for the year of 2023, which is a record high for the business by far. So Meta is producing a record amount of free cash flow, its operations are growing, and its revenue is growing at 25% annually now. It's honestly a great report. Meta, it's just mind-blowing. Now, Meta is also using this free cash flow to repurchase shares. They repurchased about $6 billion worth in the fourth quarter and about $20 billion worth in the trailing 12 months now. Now, what is insane about this is Meta repurchased about $20 billion of shares in the year, right? They also had about $27 billion of capital expenditures, yet the company still managed to grow its cash position by $27 billion throughout the year. This is crazy to me because in 2022, when Meta stock was worth about $90 a share, the entire market cap of the business was about $250 billion. And in the year of 2023, they generated about $46 billion in free cash flow, which means that a free cash flow yield on cost of shares purchased at the dip there, or at the pit of the sell-off for Meta, is almost 20%. That is insane. That is how undervalued Meta stock got in that massive sell-off. And it's also how fear can create opportunities on fundamentally sound businesses if they are seeing some short-term fear or weakness in the stock market. Meta has one of the most crazy stock charts I have ever seen. It is like it fell off a cliff and now it's going to be up almost 500% when it opens tomorrow. Just freaking crazy. So in after hours now, Meta is worth about $1.1 trillion. They also did about $46 billion of free cash flow in 2023, which means that the stock is now trading for about 24 times free cash flow in after hours trading, even when the stock is up 14%. Now, honestly, if Meta can continue to grow its revenues at 20% annually like they currently are, then this is not an insane price to pay for Meta, especially when we also consider that the business is cash rich and has tens of billions of dollars on the balance sheet. I was not expecting this from Meta at all. And in hindsight, yeah, it looks like I made a mistake selling my Meta shares so early. But again, I did not expect this. We now have the perfect clarity of hindsight, and it makes $250 look like an absolute steal for Meta. But again, if Meta can actually continue growing its revenues at 20% annually, then a 24 price to free cash flow for this business actually does look quite cheap. I need to dive into this business more to try and understand what is causing this business to grow so quickly right now, and if that is sustainable over the long term, because at this moment, I actually don't know. And I don't know if this is going to be a short-term thing or if Meta is going to grow its revenues rapidly over the long term. Because if this is just a one-time thing and then they get their revenues back to 3 to 5% over the next few years, then this price ratio starts to look expensive. So for me, it's all about what is the future growth potential of this business now? And is it going to be rapid or is it going to slow down? That is the question that I would want to answer before I could confidently say that a 24 price to free cash flow is fair for this business. But out of all of the Magnificent Seven, Meta has reported the most ridiculous earnings report. They win this round. They win a 2023. They win Q4 2023, and the market is definitely rewarding the stock with a 14% share price appreciation and after hours trading now. So let's move on to Amazon. This stock is also up, it's up 9% now in after hours trading. So Amazon is also absolutely killing it. And if you watched my video at the beginning of the week when I did my earnings expectations and kind of what I was expecting for the Magnificent Seven earnings reports this week, I did say that I thought Amazon had the highest chance of seeing a pop like this because I actually do still think that the stock is cheap, which we will get into here in a minute. And I also said that I think Meta could outperform and see a boost in after hours trading as well. I said that I thought Google could see some weakness, Microsoft could see some weakness, and Apple could see some weakness because those three stocks were pricing in a lot of optimism and near perfection. So if those businesses did not report perfection, then those stocks most likely would have come down. And actually, that did happen to all three of those businesses. I was not expecting Amazon and Meta to pop this much, though. This is pretty crazy. So let's get into Amazon's earnings report here, and let's take a look at what happened. For Amazon, net sales did increase by 14% to $170 billion, which beat analyst expectations and my own expectations. Amazon sales are growing really well on $170 billion of revenue. That's pretty incredible. North American segment sales increased 13% year over year. International segment increased 17%. So the international segment of Amazon's business is actually growing quite significantly faster. And I do think that this will continue in the future over the long term, in my opinion. Now, one negative thing here actually is AWS sales only increased by 13% year over year. And the reason that I say this is negative is because Microsoft's cloud business is actually larger than AWS now, and it's growing at around 20 to 24% annually. Google Cloud also grew by roughly 26% year over year. I understand that Google Cloud is much smaller than AWS and Azure, so it's easier for that business to grow quickly. But still, when you compare AWS versus those other two businesses, AWS is growing significantly slower now, which could be seen as a negative by the market. And typically, this is actually kind of surprising to me because typically the market focuses just like on AWS. What is AWS doing? And we're going to value the entire business of Amazon off AWS, which I think is a mistake, but that's typically what the market does. So seeing AWS sales at only 13% year over year and the stock being up 9% is maybe suggesting that the market is looking beyond just AWS now, which could be a good thing. Anyways, operating income did come in at $13.2 billion, which beat the high-end projections for Amazon. I believe they were on the high end projecting about $11 billion in operating income. So they blew that out of the water. Operating income for the full year was $37 billion, which is an increase of 200% year over year. Now, my favorite metric here, which is Amazon's operating cash flow, increased 82% to $85 billion for the trailing 12 months, which nearly doubled year over year. As I have said on my channel consistently, operating cash flow seems to be the metric that the market follows on Amazon, and we will be taking a look at Amazon's price to operating cash flow here in a minute. But seeing its operating cash flow increase like this is definitely going to put upward pressure on the share price, and that is probably why the stock is up so much in after hours trading. Now, additionally, Amazon did produce free cash flow of $37 billion in the trailing 12 months. So the company is producing real cold hard free cash flow once again, and a significant amount at that. Now, their first quarter 2024 guidance says that they are expecting 138 billion to 143.5 billion, which is growth between 8 to 13% year over year. So it looks like they are still projecting to do some strong revenue growth in the first quarter. Also, operating income is expected to be between $8 and $12 billion, which is double what they reported last year for the first quarter. So revenue and operating income look like they are projected to continue growing in the first quarter as well. Now, I found this chart right here on Twitter from Jimin Ball, which I think is great and kind of explains the bearishness towards AWS right now. So here we can see AWS's year-over-year growth rates. We can see that it's really slowing down to about 13%. Azure is also slowing down to about 22%, and Google Cloud is at 26%. But overall, we can still see that AWS is the slowest grower here by far. So I thought that that could be seen as a little bit of a bearish thing. But now let's move on to Amazon's cash flow statement, which is my favorite financial statement here. And we can see that its operating cash flow did grow to about $42 billion on the quarter. Now, what is insane about this is for the full year of 2022, Amazon did about $46.7 billion of operating cash flow. So just in the fourth quarter, the most recent quarter, Amazon also produced as much operating cash flow as the full year of 2022. To put things in perspective, that is how much margin expansion and profitability expansion is happening at Amazon right now. And then once again, we can see that Amazon produced about $85 billion in operating cash flow for the full year of 2023. CapEx was also about $52.7 billion, which again is that $36 billion in free cash flow. CapEx is also declining while operating cash flow is growing, which is a great thing to see for the company's free cash flow. Now, this next screenshot takes a look at Amazon's different segments of the business and how they are growing. So I have some underlined things here. Amazon's third-party seller services generated $43.5 billion in revenue in the fourth quarter, and it's growing at 20% annually. Year over year, it grew at 20%. So it's a $43 billion business growing at 20% annually. That is insane. That's basically Meta. Amazon's third-party seller services right there is basically Meta. That's crazy. Advertising services came in at $14.6 billion, and it's growing at 27% year over year. I think that this is awesome to see, and I love to see that Amazon's advertising business is growing so strong. Subscription services came in at $10.5 billion, and it's growing 14% year over year, and AWS came in at $24 billion, and is growing at 13% year over year. Now, what is interesting about this, and what I want to point out here, is Amazon's third-party seller services, again, is a $43 billion business, so it is almost twice the size as AWS, and it is growing faster than AWS. So this is why I say when the market is focusing just on AWS for Amazon, they're being short-sighted, because Amazon is so much more than just AWS. Their third-party seller services is a much larger business, and it's growing much more quickly. I love to see this, and I think it's a great thing. Now, as we saw, Amazon did do $85 billion in trailing 12 months operating cash flow, and the company is currently worth about $1.6 trillion. So if we take $1.6 trillion and we divide it by 85, then it means the company is now selling for a price to operating cash flow of about 18.8. Now, why I like this and why I think that Amazon is actually not that expensive right now is because if we head over to Amazon's historical price to operating cash flow right here, and we zoom all the way out here to 2010, we can see that the bottom that Amazon likes to trade for historically is around 20. Here in 2016, Amazon clearly bottomed at a price to operating cash flow of 20. Here in 2015, they also bottomed right at 20. Here in 2012, they bottomed at 21. Here in 2011, they also bottomed at 21. So at least historically, whenever Amazon's price to operating cash flow got down to around 20, the market would come in and buy up the stock. And it was very consistent whenever Amazon's stock hit this price. Now, what's interesting is right here in 2022, Amazon's price to operating cash flow fell to about 18.8, and then it stayed down here in this 20 range. Now Amazon's price to operating cash flow, since their cash flows are growing so much, the company is once again selling for this price ratio of around 18.8, which by the way is the cheapest this stock has sold in the past about 14 years now. So what this overall means is in terms of Amazon's price to operating cash flow, it's actually at around a 14-year low once again, which could suggest that the stock, at least relative to this metric and its historical averages, is actually quite cheap and not looking very expensive at all. So in my opinion, out of the Magnificent Seven, I actually think that Amazon is the cheapest stock right now and would be the stock that I would be the most inclined to add to, even though it's still up 9% in after hours trading. Overall though, Amazon had a fantastic report. Their operating cash flows are continuing to grow, which is exactly what I wanted to see, and that should be continuing to push the stock price higher. The report wasn't quite as crazy as Meta because Meta just blew it out of the freaking water, but Amazon's report was still very good. They still beat their high-end estimates for revenue, operating income, net income, operating cash flow, and everything. The only downside here is that AWS is really growing at a slower rate than Google Cloud and Azure. But other than that, this was an incredible report from Amazon, and I do think that it deserves that 9% plus in after hours trading. All right, now the last stock that we got to talk about here very quickly is Apple, which is now down about 1.6% in after hours trading. And in my opinion, this is actually very fair. All right, so here is Apple's income statement. And we can see that their revenues for products are actually growing slightly year over year by less than 1%, but product revenue did grow. We can also see that their services revenue did grow by roughly 15% year over year, which is a good thing to see. So the total sales did grow to about $119 billion, which is a growth of about 1% year over year. Now, this is not a significant amount of revenue growth for Apple. And I do kind of think that the stock does deserve to be down roughly 1.6% in after hours trading. I'm actually surprised the stock is not down more because it's growing revenues by about 1% year over year, but it's trading for about 30 times cash flow, which is a pretty high multiple to pay for a business that's not really growing its revenues. Now, if we head down to Apple's cash flow statement, we can see that they did do about $40 billion in operating cash flow, which is growth of roughly 15 to 20% year over year. This is actually quite good to see. The capital expenditures were also only $2.4 billion, which is next to nothing. So the company generated about $37 billion in free cash flow for the quarter. They then used $20 billion of that to buy back stock, and then they paid about $4 billion in dividends. So the company is using the majority of its free cash flow to actually buy back shares, and this is what Apple does. Overall, though, it is nice to see the company's operating cash flows and free cash flows growing significantly year over year, despite the revenues not really growing. However, again, Apple is still trading for roughly 25 to 28 times free cash flow, which I do think is a pretty significant multiple to pay for this business, because we just have to put things in perspective. Meta is now trading for a price to free cash flow of 24, and it's growing its revenues by 25% year over year, at least in the fourth quarter. So there is a significant amount of more growth there at a cheaper price ratio. And that's kind of why I say that Apple is a more expensive business right now. So I think that Apple is just pricing in actually more growth than the business is currently seeing. So if I were looking to buy shares in Apple today, I would really want to try and understand where is this business's growth going to come from and where is it going to pick up? Like, what is going to cause this business to start growing its revenues and everything at 10% or more in the near future? Because if they don't, then I personally think that this is a high price ratio to pay for a slow growing business. And personally, I would not be buying Apple at this price ratio today. I would want a pretty significant pullback before I became interested in Apple. It is a stock that I could see myself owning in the future, but again, I would want a significantly lower price, and I don't know if it will ever get there. So in the meantime, I will just be patient. But that is my opinion on Apple, Meta, and Amazon. There were some pretty wild reports today, especially with Meta. And if you enjoyed this video, then please remember to leave a like on it. And if you're new here, then please consider subscribing to my channel as well. Also, once again, my book, The Fundamentals of Investing, will be officially released on Amazon on Monday. I will be doing a video here on my channel going over the book and all of the content within it and what you can expect to get from it. And again, there will be an ebook and print version. I really wanted to respect the people who want to read on mobile, but I also wanted to respect the people like myself who really love reading books in person and into your hands. Again, you can probably see the book on my shelf back there. I'm so excited to release it and get it in your guys' hands. It's a fantastic book. There is a lot of gold in it, and I absolutely love it. So I cannot wait to release it on Monday and have you guys get it yourself. But with that being said, thank you all so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.